As mortgages continue to renew in Canada into these higher interest rates, many Canadians are going to feel those payment shocks, which is going to translate into less disposable income at the end of every single month. And for some Canadians, this is going to be a major problem as these payment shocks set in. Welcome back. It's Friday, Finance Fridays, and I'm your host, Anthony with InTouch Mortgage Solutions. On this week's episode, we're going to do our monthly mortgage rate update. We're going to talk about where interest rates were, where they are right now, what it means for some Canadians who are renewing their mortgages, how much will this actual increase look like or shape out to be at the end of every single month, and having a conversation about where interest rates could be headed, especially with all these geopolitical conflicts that are unfolding across the globe and how they translate into Canadian fixed rate mortgages. As we've talked about on several episodes, is the US bonds, these treasuries that continue to stay elevated, which are obviously impacting the Bank of Canada 5-year government bond, which in turn impacts fixed rate mortgages for things like a 5-year fixed mortgage and even short-term mortgages. So as this continuation, this volatility in the US and geopolitically across the globe begins to play out, it's going to keep most of these mortgages, these fixed rate mortgages, elevated for longer, or at least that's what the Bank of Canada is anticipating. We talked about it last week. The Bank of Canada hit the pause button. They are meeting again in December to discuss what will happen next with policy rate decisions. But as these interest rates remain elevated, it is doing a lot of the tightening for the Bank of Canada because Canadians are going to be renewing into higher rates. Higher rates means less money at the end of every single month in Canadians' disposable income. Now, for some, these particular increases may not be the end all and be all. For some, it's just an inconvenience. For some, it's going to mean the difference between being able to continue to shop, continue to go out and eat dinner. But at the end of the day, I think the Canadian sentiment, consumer spending right now is turning over. More and more Canadians are reverting to savings as uncertainty continues to unfold on where the Canadian mortgage and real estate landscape is going to be in the next few months. And we're seeing that as these mortgages continue to renew, the conversations that are being placed in the media. And rightfully so, I think Canadians should be prepared for higher interest rates. We do get this conversation where individuals think, hey, interest rates are going to come off. And I agree, they're going to drop at some point. Are we going to see interest rates where they were during the pandemic era? Absolutely not. I don't think we're ever going to go back to that particular point unless there's a black swan event, something that obviously triggers the central banks to have to pull back to near zero rates. But I think they've learned their lesson. They know exactly now how introducing new money, new spending, quantitative easing is going to play out in the Canadian mortgage landscape. And they're going to be very conscientious in ensuring that inflation is absolutely dead before they even contemplate having to pull back on interest rates. But obviously that's a conversation for another episode. And if you're interested in staying up to date what our thoughts and opinions are, what's happening with the Bank of Canada and what's happening with interest rates, make sure that you are subscribed to the channel and you hit that notification bell to get notified every time we post a new video. So with that being said, let's unpack some of the different products available to consumers that might be approaching mortgage renewal, or even if you're looking to go out there and purchase and get a pre-approval. Now, the first product, very important to understand when you look at rates, is the insured mortgage. This is generally the cheapest mortgage available, but it does come with some restrictions, meaning that you have to purchase with less than 20% down. You cannot exceed a purchase price of over $1 million. The maximum amortization you're allowed to take is 25 years. And if you're buying with less than 20% down, you have to pay the default mortgage insurance premium to either CMHC, Canadian Mortgage and Housing Corporation, Sagan, or Canada Guarantee. They are all the same, ranging from about 2.8 to 4%, depending on the amount of your down payment, but this is for a purchase only. Now you have insurable switches, purchases, and transfers, which is basically what you think about when you're switching that mortgage over. So maybe you're buying, maybe you're switching or transferring. If you're purchasing, you have to have 20% or more down. If you're purchasing or looking to switch or transfer, that valuation of that property should be sub $1 million. The maximum amortization you're allowed to take on is 25 years or less, and there is no default insurance premium applied to an insurable switch or transfer or even a purchase. So this is a particular product that might be of interest to some individuals as they approach mortgage renewal in the coming weeks, months, and years ahead. Now, another important side note that came out from OSFI, the Office of the Superintendent of Financial Institutions, in light of the B20 guideline changes, is that if you purchased a home, let's say 5 years ago or longer, and you paid the insurance premium. So if you bought the house with less than 20% down, you paid that insurance premium, you are able to now switch or transfer your mortgage to a different lender without having to go under the mortgage stress test rule. Now, it's important to understand it is not for a refinance. You're literally just taking the existing mortgage balance from lender A and you're switching it to lender B. You're not taking out new money. You don't need to requalify. This is no different than an individual that is renewing their mortgage with their existing lender and they're just signing back. Now, it's important to understand that in this transaction, you still need to collect all the employment and income documentation. The lender will still review the eligibility, but you don't have to undergo the stress test rule. You can take the existing contract rate and qualify the deal at that particular point. So I think this is great for competition because it will allow individuals to not be hand-tied to their particular lender, especially if that lender is not offering them a very competitive rate. You can now switch over to a different lender at a significantly lower rate and not have to undergo those qualifications. Now, the final product that we want to discuss is the conventional mortgage, which is for purchases or refinances. And if you're looking to take a 30-year amortization, maybe on a purchase, maybe you're looking to refinance, consolidate, you want to gain that extra advantage of 5 years. The conventional mortgage, obviously 30-year maximum amortization. You can do a lot less, but 30 years is the max. The purchase price can be $1 million or more, $1 million or less, but if you're looking to buy for over $1 million, you need to have the 20% down in order to do so, and there is no insurance premium added to this mortgage. So this is a particularly different product for some individuals, and consulting with your mortgage professional about your options, especially if you're purchasing or refinancing, if there's a lot of equity in the home, is an important conversation to have, especially if you're looking at the insurable products, if you're looking at conventional, how much that loan to value is, it can determine how much money you could save. So let's look at some of the current rates that are being offered, some of the best rates for some of the most popular products being offered. The 5-year insured mortgage right now is anywhere from 5.74 to 5.79%, depending on the lender that you select. Generally, these are our broker-friendly banks that are offering a significant discount for their particular 5-year product. And obviously, you can now look at particular product if you are thinking about switching over for a 5-year insured or insurable product. There are some differences on that loan to value, but the 5-year insured variable rate product is around 6.20%. We're seeing about a discount of prime minus one full percentage point on that particular product if you're contemplating taking on a variable rate product in this environment. Side note, very important to understand if you're selecting a variable, understanding if it's a trigger rate mortgage with a static payment or an adjustable one, which could determine how you perceive that mortgage in the next little while. So if those payments are going to go up and down with the Bank of Canada policy rate decisions and prime lending, or they're going to stay the same and more money goes towards principal or interest. So very important to understand. And the 5-year conventional mortgage now sitting around 6.34 to 6.39%, obviously depending on the lender and any incentives or bonuses that are being offered. Now, a lot of these products also do have, some of them have a cashback component, some of them don't. So it's very, very important to understand the differences in those products and what that cashback could mean in regards to your penalties if you have to break that mortgage, so on and so forth. Obviously, speak to a mortgage professional, understand what those differences are in those particular products. Then there's the 5-year variable rate conventional mortgage. That has moved up a little bit, or actually come up a little bit in the sense of the discount, because just in October, there was a significant discount on those particular products, around 30 to 40 basis points off. Now you're looking about 10 to 20, maybe 25, 30 basis points off. So you're going from 6.8 to around 70% basically right now. And this, I believe, is also to do with the fact that the Bank of Canada has now hit that pause button. More individuals may be contemplating taking on a variable rate mortgage, especially if they believe, and this is what we hear happening right here on the ground floor, is that, hey, interest rates are at their peak. The only place for them to go is down. So some individuals may opt for this variable rate product, but obviously speaking with a mortgage professional, understanding your personal finances, your ability to stomach the volatility is more important, what it means for your household budgets if interest rates end up going up. Obviously, if they come down, could be beneficial, but remember, if you're in a static mortgage or with a trigger rate, your payment rate remains the same. Your payment stays where it is, versus an adjustable rate mortgage where those payments are going to go up and down. 3-year insured mortgage, 6.24%, and a 3-year conventional mortgage around 6.74%, give or take about 5 or 6 basis points, 10 basis points, depending on the lender. But that is obviously what we're seeing happening right now. Not too much movement in some of those products, but we did see the change in October from 6.59 to around 6.74 in November. Obviously, a little bit of a bump up in those shorter term mortgages. And then the 6-month insured product has remained level at 5.50% as of November 2nd. These are the current rates. Now remember, these rates are subject to change depending on what happens in the bond markets, in these yields, in these treasuries. As they begin to change, the banks are very quick to change potentially their payments to bring them up or those mortgage rates to go up. But if the interest rates come down, especially in this environment right now as we approach year-end Q4, maybe the banks are not going to be as competitive as they round out their balance sheets for the 2023 year. And now I want to take an opportunity and go through some of the actual scenarios that I've been working on with some of our clients, just to sort of showcase how these higher interest rates can play out to some Canadians. Now, keeping in mind this is one particular case for one individual, but it gives and it does illustrate sort of exactly what things look like. Now, this particular client had received a promotional rate back 5 years ago that we were able to get for them at 2.99%. They had a payment of around $2,100.35, and they started off with a 30-year amortization. So now, because of the fact that they've paid down their mortgage significantly, they're now renewing at 25 years or less, they are eligible to go into a switch or transfer, but not under the bypassing of the stress test rule. They still have to qualify under the 2% because they started with 30 years and they didn't pay the insurance premium, but they're able to qualify at 5.79% for 5 years, and their payment would now move to $2,787.44, and it's a difference of around $687 from their original payment of $2,100 that they had. Now, if they were looking at a 3-year product, they can still take an insurable product, switch or transfer at 6.24%, still having to qualify at 8.24%, for example, because they did not pay the insurance premium, but they now would see a payment of $2,906.36. For this particular client, it's around $806 difference from their original payment. Then if we were looking at extending it, the client's like, look, what about if I went to 30 years? What would that option look like, right? And we did the math at 6.39%, slightly higher on the rate, refinancing the mortgage back up to 30 years. Their payment would be around $2,752, a difference of around $651.65. Looking at the options, the client was sort of under the impression there would have been a lot more savings, but between 651 and 687, client was like, look, instead of having to requalify everything at 30 years, let's just requalify, go to 25, get the significant discount on the 5-year rate or the 3-year rate, because it wasn't worth them for them to actually go through that process for an extra 5 years and reset the mortgage. They're looking to pay it down as quickly as possible. So as you can see, these options are important. Each case is individual to you, particularly as a household. The best advice we can give you is if you're looking to run these scenarios, you can actually download our app in the description box below. It's free, and you can look at the refinance options, you can look at your payment options, servicing options, income required. Even for individuals looking to buy, there's a pre-qualifier. There's even land transfer tax calculators, all kinds of tools that you can download in the description box below. But let us know in the comment sections below what you think about these higher interest rates. What is it going to mean for mortgage holders, for the real estate market moving forward into 2024? But we'll leave the video here, wishing everyone a wonderful Friday and an even better weekend ahead. Thanks again for clicking, and we'll see you next week.